Anthony is kind of our timekeeper. He's usually the one that puts the kibosh on our fun. So
he kills the party every time.
Yeah. Everybody go home. You don't have to, well, actually, you don't have to go home, but you can't stay here.
I like it.
All
Yeah,
right,
so we'll try and wrap up at around 7, at the top of the hour. We'll try and get everybody out of here. Go to dinner.
All right, I'm gonna go live, and Anthony, you're ready for that awesome intro.
Born ready.
Born ready. You're gonna edit on the fly with the appropriate content?
Probably. I hope so.
Let me know when you're ready, and I'll kick it off.
Oh no, I'm ready. Yeah, one way or the other. You know, kicking and screaming. We're going through the breach. Hello. Welcome to the Weekly Multifamily Roundtable, where each week we three amigos, Anthony, Dan, and Rodney, get together to try and learn something new about multifamily investing. Whether you're new to apartment investing or old and crusty like us, if you're looking to take your real estate investing career to the next level, then you're in the right place. So come join us as this week we set off to learn more about underwriting during the COVID pandemic with the one, the only Drew Whitson. Now, if you're opposed to fun or learning, then you best get on out of here because the Weekly Multifamily Roundtable is leaving the station. Dan, give me a toot toot.
Toot toot, beep beep.
All aboard. All right. So with that, Drew, welcome to the show.
Hi guys, welcome. I thank you for having me. It's you guys are like the drive time shock jocks thing going here. That's
Exactly.
We need sound effects. We need somebody to have like the awooga and like the different sounds. Yeah.
Rodney, I'm looking at you for that.
Yeah, I got some. I'll pull them out here momentarily.
Next week.
So for our listeners at home, Drew, why don't you give us the 30,000-foot view? Who is this guy besides a fellow Minnesotan? Just so everybody is very clear. This is a very special occasion because we have 4 Minnesotan boys in the house.
Don't you know?
Yeah, you betcha.
You betcha. Yeah. So I have been investing in real estate for quite a long time, maybe 12, 13 years. Started out in single family homes right when the market was starting to crash, the 2009, 2010. When everyone was telling me what a bad idea it was to buy real estate, I was in there just scooping up stuff because the math made sense to me. And as that single family home portfolio started to rebound, I ended up being able to sort of shift into the multifamily space. And from there, I was able to do some of my own deals, pick up some partners, and ended up getting into the syndication, where I now represent a group of investors that we acquire larger multifamily assets throughout the U.S. And after I was able to achieve a certain amount through that strategy, I ended up leaving my corporate W-2 job, maybe 3 years ago. And now I am a real estate syndicator. I also am a full-time professor of finance at Bethel University, which is my alma mater. So that's my high-level story. That's kind of where I sit today.
So Drew, you came on my radar about this time, almost exactly a year ago. Actually, this is when I met Dan, was at the North Star conference. And you we're almost at our, I don't remember exactly the date, but you were a panelist on multiple different panels. And I remember walking away and thinking, that guy is very sharp. Would you confirm or deny that?
I'd probably deny it. You can, you just need to get to know me better. I'm sure you change your tune on that.
Yeah, and I think I especially liked all the stuff you said, just because you're a finance prof, and I'm a finance geek, so everything you said was like speaking the same language for me, which I could appreciate.
Yeah,
but it's also kind of cool that like your trajectory is kind of like maybe not your trajectory, but your bio is almost like the ideal case scenario for someone getting into real estate. They're doing the corporate thing, and they figure real estate's a better wealth creating mechanism than a corporate job, and then you get to spend your time doing what you really enjoy, which is educating people about that fun financial side of things that some of us love, but most of us it's not the favorite. So.
Right. Yeah. I mean, really the genesis, I think the impetus for me starting into the real estate was that I got laid off twice from a corporate job. I got laid off twice in 1 year. And I sort of had this moment of reflection that said, I no longer want to be beholden to a faceless corporate entity to provide the financial security for my family. And I think that was the first step that just said, I need to figure out a way to build income passively, generate wealth. And so I really kind of pivoted my life to thinking about things not from an income statement perspective, but from a balance sheet perspective. And that really kind of shifts how you think about things. And so that was really kind of the main driver there was, just trying to find an opportunity to figure out what was important to me and some strategies around that. So it's been very freeing. And I think that there's sort of this idea that once someone achieves a certain level of, financial or real estate freedom, that you're going to go sit on a beach in Mexico. You're going to,
get those Mai Tais.
Get the Mai Tais, right? And I've met people that have done that, and to a T, there's this window of a couple months, and they say, I just need to I need to produce. I need to do something that contributes into this world. Or I need to sort of find ways to engage in things non-financially that have meaning to me. And so I think I see both of that happening. And I've been fortunate enough that after I sort of was able to quit my job, and because I think of myself as I don't have a job in real estate, I'm an investor of real estate. And if you're an investor of real estate, it doesn't take up your time. And so I have enough time free that I can do what I think is meaningful and interesting. And that was go back to my undergraduate alma mater and teach students about financial valuation and managerial finance, and kind of get to share a little bit of my life story, and hopefully in some ways invest in them in the ways that I was invested in as a student that made me successful.
That's a really cool story. I love this idea that, money doesn't solve all your problems, but it solves all your money problems. And once you've solved all your money problems, that frees your time and your energies to solve the other problems in life that are maybe more interesting and compelling than the ones that revolve around how am I going to feed myself. Right now, you can start solving the problems of like, how do I bring up the next generation of entrepreneurs or finance majors, and like, how do I start improving and making impact in the world around me?
Yep, I have my Matabidai basketball shirt on.
Ooh.
And I have to tell you, I last year was I have twin girls that are in 5th grade last year, and I was their basketball coach. And if you knew me better, you would know why that is a pretty funny thing, because I had literally never played basketball in my life before. I didn't even know the rules of basketball, but I was the only dad on the team that was totally free to kind of control my time. And so YouTube and I was learning drills on YouTube and trying to figure out the rules, and we did okay. We had a lot of fun. I'd say we had a lot of funs and high fives than we did a lot of just dominated wins. But
those are good problems to have, right? The problems where you get to figure out how to coach girls basketball with your daughters. Nobody's complaining about those issues.
Right.
I'm curious. I was just kind of curious. This isn't really related to our underwriting during COVID topic, but I'm curious, just since you're a finance professor, and I went to school for finance too. I went to St. Thomas, and so I went through that kind of trajectory into corporate finance and kind of did a similar thing. But I remember when I was in school, it was really focused on creating really great corporate financial analysts. That's what the program produced. And there wasn't a lot of talk about more entrepreneurial endeavors or investing outside of a derivatives course and, some stuff like that. But are you kind of, given your unique skill sets and things that you do, are you being more vocal about stuff like that than some of the other profs are? Are you kind of encouraging people to look into not necessarily just going and try to work at Target or Cargo, but going and starting their own enterprise or investing?
Yeah, there's a little bit of a balance there, right? I try to bring a little bit of what I do from real estate into the classroom. So for example, I teach a class called Financial Valuations. It's a senior level course for finance majors. And we work through, it's kind of an Excel-based modeling. We do a lot of different valuation strategies, but I do a lot of real estate valuations in there, because really the structure that we use for real estate syndications is the boilerplate structure that's been used on Wall Street for private equity for the last 60 years, right?
Yeah.
So in one sense,
discounting cash flows from a building instead of a company.
Correct. Yeah, exactly. And so, what is a limited partnership versus general partnership structure? What's the carried interest, right? That's kind of where the big guys on Wall Street make their money, is some of those positions, and how that capital is raised through accredited investors. So I give them a little bit of a peek into sort of what the private side of private equity is, because you don't hear about it. It's pretty private. So one of the fun things I get to do, and I have enough active deals, is that through the semester, I'm usually able to bring my class along through a deal. So
That's
I'll
pretty cool.
talk about here's how these are structured, and then we'll talk about how they're financed, and then another week we'll talk about how you raise money, and then how you. So I kind of move them through the process along the semester just to kind of give them some awareness of what exists, because I didn't even know this kind of thing existed, right? I mean, you were sort of trained up in undergrad. You don't really think of things as like go out and build income producing assets, and that's really hard to tell a 22-year-old to do because they don't have any skills or experience or money or network, right? So it's something that you kind of want to provide just an awareness that it exists, and then it will start coming back as each of those capabilities expand through their career. And some of them, it gives them an awareness, say, look, I can go right into working as an analyst for a private equity group here in Twin Cities, but no one's ever heard of them, right? They're all things you've never heard of. You have to sort of be in the bubble of private equity to figure out sort of where these hedge funds sit and where these private groups invest. That's
super cool. That's a hugely valuable resource for those guys. I wish I'd had someone like you as a prof so I could get a little bit more exposure to that kind of stuff that you just don't hear about. Like the whole private equity world was very mysterious in college. It wasn't even really discussed, honestly. I mean, we kind of looked at some things from the perspective of a PE firm, but we didn't really call it that. We were evaluating companies and deciding whether something was a good deal or bad deal, but we didn't really take it a step beyond. So that's super cool.
And I would even go so far as to say, even now, there's still kind of a dearth of information out there when you're trying to pierce that private equity veil. There's just not a ton of really high quality resources in that way. Dan and I are looking at, what's it look like to start a fund, and like the questions there are pretty difficult to answer because there's not a lot out there. You have to really sit down with your lawyers, and that's kind of it.
Yes. Yeah.
So Drew, you said something before we like dive into the underwriting aspect of COVID and how that's, changed our models. You mentioned something that I thought was really interesting, which was that you stopped looking at things through an income perspective and started looking through a balance sheet perspective. For our listeners who've maybe never even heard of that paradigm or thought through that dichotomy, can you just break that down a little bit more and explain that?
Sure. I think traditionally people want to talk about how much money they can make, right? They live their life through an income statement to say, how much money can I make? And they concentrate on a top line number. And a dollar produced through working more or harder is different than a dollar that is produced through balance sheet means, making an investment, right? If you earn an extra dollar at your W-2 job, it means you've got incremental payroll taxes, you have incremental income taxes, right? It all kind of trickles down to the bottom, and it's not a replicatable. You have to work to earn that money. A dollar that you create through an investment mean, through the owning of an asset, that is taxed at a much lower rate. There's no payroll taxes, right? Gains are taxed somewhere between 0 to 15%, whether it's a dividend or long-term capital gains. So a dollar created on the investment side has more value than a dollar created on the income side. And it's amazingly true. Some of the people that I went to school with as an undergrad who are now doctors and surgeons, these guys make obscene amounts of money, but they have no balance sheet, right? They don't have any net worth. They are just highly paid day laborers, right? They are just going out and just doing surgery, right? And every time I say, hey, you should invest in one of my deals, they can't even put together that, they can't even fathom putting together that kind of money. Versus people that I know that have built businesses and think of their income stream and their wealth differently. They're my group of investors I can keep coming back to every day on deal after deal to help fund that. And so I think as you think about your life through a balance sheet perspective, you can sort of make this mark of say, am I generating wealth? Am I paying down debt? Am I using leverage appropriately to grow my equity, right? Am I minimizing my amount of taxes and I'm making trade-offs in my time in order to create wealth, not create just top line income?
Yeah, it's a tough switch for a lot of people to make, I think, especially like you mentioned those high income earners that are kind of distracted by the fact that they do have a big paycheck, but a lot of those people are still just living paycheck to paycheck. Like if that paycheck turns off, they're in trouble. And then there's that ceiling of there's only so many hours in a day. So if you're continually trading an hour for money, you're going to hit a ceiling no matter how high your hourly rate gets. But with investing, that can, be scaled infinitely, theoretically. So
Absolutely.
Yeah, I had a conversation with a close friend a week or two ago. He's, a high earning doctor, right? And it's really easy, I think, for those guys to get into this mindset of I make so much, it's all going to be okay. Like when I decide just to kind of buckle down and start saving, it's going to be fine. And his approach to to retirement was really interesting because he's like, I have no spare money right now because I'm just saving every dollar so that I can retire as soon as possible. Like I've sat down and I've plotted out my retirement, and if I save X, then I will get there. And I was like, that's such an interesting, like you're locked into this, like saving your way to retirement, which is,
so I wonder where the money goes while he's saving.
exactly. Yeah. That's the question, right?
But it's locked up in, IRAs and things like that, and 401ks. I mean, my brother's in the same boat. I talked to him about, and his wife works for Mayo, and they're higher income earners, but it's the paradigm shift thinking that you're talking about. And sometimes I think that we have to go out and re-educate people in the way that they think about their finances, because the whole balance sheet concept that you were mentioning, Drew, is something that a lot of people don't understand.
Mm-hmm.
Right. And to the extent some people think of it, they think on the wrong side of the balance sheet. They spend time worrying about every little $5 or $10 they spend, right? It's how do I minimize
saving on that latte?
Right. Like the whole latte thing. Like, I mean, that's like, don't worry about your $2 or $3 latte. Figure out how you can make $1,000, right? Don't worry about the coffee. Figure out how you can create wealth, not minimize expenses. I think that's a tough trade-off. I think you're chasing the wrong, you're going to find the benefit of chasing wealth creation, not expense reductions.
Yeah, this is something we talk about at my other businesses, which is you can't save your way to profitability. You can't do it. So you have to run a tight, efficient operation, obviously cut expenses where you can, but that's not the way to growth.
So when you run across somebody like that, do you try and educate them in their perspective, or do you not worry about that?
I try to provide an opportunity for them to think of it differently, but I mean, a leopard doesn't change its spots, right? I mean, people are sort of the way they are. I'm happy to help them think through it. But I don't try to convince them to think differently. I mean,
people need to
really
want to learn more about it too. Cause there's a lot of people that are just they have a wall up about money and finance and retirement. It's almost taboo.
I get it all.
Very taboo. Invited in before you start, the unsolicited education stuff.
Correct.
Yeah. You can't just throw that out at a party.
Yeah, especially on money. That's a tough conversation.
Yeah.
If they're open to it, I'm happy to share it. But otherwise,
you got to fight the fights you can win.
Yes.
It tends to be very personal, hold to the vest kind of thing. And like you said, it would be nice if a lot of people would be more transparent about it, because there is so much they could learn, but they've always heard that it's a personal issue. We don't talk about that.
Right.
Mm-hmm. Well, let's transition this. Let's get to the details of underwriting, because Drew, Dan, you guys are both finance number guys. I think we can have a really good conversation about our underwriting practices pre-COVID and now, what's
intra-COVID?
Intra-COVID, sure, yeah.
Not
so
post, right?
Not post. We're not through it yet, guys. Stay buckled up. Don't take your seatbelt off until this ride has come to a complete stop. So, Drew, what? Yeah. What? How has your underwriting practice during COVID kind of shifted?
Yeah. So I think there's probably three big things that I can sort of point to. Just speaking to a deal that we got wrapped up funding this week, so I can speak about it now. We're all done raising. One of the things that we did with our underwriting for this deal is that for the full 5 years, we did not assume any rent increases. So for 5 full years, it's completely flat. We assume our rents get to market, and then we don't have any upside for 5 years. Now, there probably will be. Historically, there's a trend. If there's inflation, there's a lot of upward momentum. But we really have, from the top line, said we're not going to build our business case off of rent growth post renovation, rent growth post rent adjustments, right? That's anyone's guess. And so we decided to leave that off the table. I think we've accounted for maybe a little bit more bad debt and vacancy than we previously have. And so that's another component that we end up having to make some adjustments on. On the lending side, we certainly have had a lot more a lot of changes on the leverage, right? We were getting, 80% funding on the acquisition and then 100% of CapEx. Like we were coming into some of these deals, 85, 87% leverage pre-COVID. A lot of the bridge lenders especially have pulled back. And so we're not able to get the same kind of leverage that we were able to get. We're having to raise a little bit more capital, which pushes our denominator up a little bit higher. And I think we're also being a little more cautious on how we value the exit. Now, I don't think there's a lot of pressure for interest rates rising. Just today in the Wall Street Journal, I read that the Fed is basically planning on holding rates through 2023 at 0, and then maybe creeping them up from them. So I don't think there's a lot of risk in the cap rate in the interest rates that we used to see. We used to spend a lot of money on our interest rate caps. Like we would buy derivatives that would help cap the interest rate floaters that we have. We've kind of done away with that because there's just not a lot of risk there. But we have been, thinking that probably the cap rates compression might still continue. We're not banking on that. But interest rate risk isn't something that we sort of really see here, that when we're coming out of some bridge debt into agency loans in 18 to 24 months.
That's interesting. Now I'm curious about the bad debt that you said you ramped up a little bit. Is that something that's consistent throughout the entire hold period, or is that for the next 12 to 24 months?
I think that's probably for the next 12 to 24 months, right? I think once you get a certain stabilized asset, you're going to have a pretty nominalized churn rate. I think one of the things we're really focusing on is higher quality assets, really looking at the B+, A- assets where some of the COVID unemployment impacts aren't going to be nearly as strong. And we're trying to create higher level finishes. One of the things that we saw in our current portfolio is that we had a lot of people in 1-bedrooms that wanted to go to 2 bedrooms because they're at home all day and they need a home office. So really increasing, so the demand for higher unit counts has gone up. 2 and 3 bedrooms are in much more demand. We really want to focus on high quality finishes. People are going to just enjoy being at their property more often. And we're also on the new property that we're working on. We have 2 new revenue streams specifically designed in a sort of a post-COVID world. One of those is that we are contracting to have a fiber optic cable run through the whole building, and our tenants have one option to get internet, and it's really, really high-end internet, and they have to buy it through us. So we spend some capital up front to wire the whole building. If they want a service contract, we basically can collect 90 cents on the dollar for every fiber optic internet connection they get.
So this might be getting a little bit too deep into the weeds, but I was curious, just kind of ballpark. It sounds like that's a pretty heavy upfront sunk cost, and then there's probably no variable cost after that. Each incremental person that adds it on, there's no cost to it. What's your break even? Where how many people need to utilize that to where it makes sense on that property? Is it a pretty low number?
It is a low number. And if you think about it in terms of a multiplier effect from an NOI perspective, right? If we can get a certain percentage of our units to convert, that revenue falls right to the bottom line. And because we're also working in a high quality property, $100 of incremental income at a 5 cap has a lot more value than $100 of incremental income on an 8 cap.
Yeah.
So I think our break even is like 18 or 19% of the building needs to get this in order to come up with a similar valuation. We're seeing in other properties, north of 70, 80%. I mean, if it's the only option available and it's blazing fast and everyone's home on watching Netflix and doing webinars at home for work, everyone's picking this up. And so the valuation is, from the upfront cost to what the NOI valuation is, it's like a 400 or 500% return at a refi event.
Now, is that something you went through a third party for, or is this done directly through the provider in the local area?
No, it's through a third party. Yeah, it's through a third party. It's called Gigify. We've used them in a bunch of places.
Rodney knows about that.
What's that?
I think Rodney brought up Gigify when we first met him, actually.
The very first time we met Rodney, the first words out of his mouth were Gigify. It was like it's kind of true. Within the first 5 minutes, we were talking about Gigify. So
that's awesome.
It depends on, and if you have think of your big rolling estates with your 6 and 8 unit, garden style properties, that's much more expensive than running it through a mid-rise. Like a 10-story mid-rise is much cheaper on a per unit basis then so it depends on the type of property that you have. The other thing that we're actually doing in this property is that we are requiring our tenants to pick up valet trash. And what valet trash does is it allows them, at the end of the day, we hire someone to walk up and down the hallways and pick up all their trash. So they don't have to bring it to the laundry chute. They don't have to do anything. They can just set it right outside their door. So we're thinking of it as a kind of a premium service. We're thinking of it as an incremental revenue stream. We're thinking of it as kind of a COVID, I'm at home all day kind of service. So those are two things that we've really identified to help provide incremental revenue to our, bottom line revenue to our higher end units.
And this
anything with parking?
Sorry, what was that, Rodney?
Anything with parking?
We haven't. That's a little more challenging. Depending on the property. I think you certainly could. If you can get a good towing company to help you out with that, they'll sometimes even pay to restripe your lot if they can get the contract. Maybe. We haven't looked into that yet. That's probably further down the line.
So was like Gigafy and the Valet Trash something that you guys looked to in order to compensate for the fact that you don't have that organic rent appreciation in there? Or were you guys dabbling with those revenue elements before COVID?
Yeah, before COVID, I think we've done the Gigafy we've probably done the Gigafy in maybe 3 or 4 other properties, and we've seen a really nice ramp up in the adoption from the tenant base. So we knew that was kind of a gimme. I think the Valet Trash is new for us. That was a new thing that we looked into, that we're also starting to see. One of the things that when you're really trying to chase like, A minus, B plus assets, is it's great to tour other assets to sort of just figure out what they're doing. And so that was a service that we saw on A-class units, not something we saw on B-class units. So just kind of comp shopping and figuring out what else is out there. Like, what can we do that's unique and different to help attract tenants and retain tenants? I think tenant retention is one of the probably underrated as one of the greatest values to your building. Is the lower you can get your turnover, the more likely you are to cash flow. I think people underestimate the financial impact of having tenant turnover.
Yeah.
So what do you shoot for? Because you hear a lot about tenant turnover. If it's not enough, you're not incrementally raising your rent enough, and then there can be a point where it's too much, where your turnover is too much. Where do you feel like the sweet spot is there?
It's hard to say. I think in a property where you really want to significantly increase your rents, you want people out of there as fast as possible, right? You want to do lease renewals at the new rent rate. So if you're looking for $200-$300 bumps, it's really valuable to cycle people out. But let me tell you, it is not worth it to kick someone out so you can charge the next guy another $5. That's just not worth it. Like, there's just too much turnover. The other constraint I would say is usually you have a limited amount of time to deploy capital. On a bridge loan, you have higher interest rates. And so your job is to spend that money as fast as possible. And if you don't spend that money on what you say you were going to, when you say you were going to do it, you can actually default on your loan, or the lender's going to start putting up a fuss with you. Because if you said you were going to turn all these units and you haven't turned many of them, right, that's capital they said was going to be deployed, which would further secure their asset and lower their risk. That was part of their plan. So you are required to do that. So I would say right away in the first 24 months, you really want to get through 90% of your units, right? That 24-month mark, get through 90% of your units. After that, I think slowing it down is probably more valuable once you hit that refinance exit.
You found that challenging during COVID? Get that the rehab deployed?
It is. It's actually a little bit slow because you have people that don't want to look for a new place, so they're not moving out as fast. You have people who are not paying rent, and you can't even kick them out because all the courts are shut down. And that's a very small part of our business. That has been not really meaningfully impacting what we've done. But it has been a little bit of a slower going. So we've done a couple of things. One, we've tried to provide incentives for tenants to switch units within the complex. Like, we'll say, hey, we want to take you out of this classic unit, and instead of charging you $200 more, we're just going to charge you $100 more, right? So we'll actually discount them to move them out of a current unit, a classic unit, into the finished unit, and that opens up a unit that we can immediately get in there and do the turn without having to kick someone else out. We can keep them within the complex and just provide incentive to shift them around within the building.
Yeah, I've heard a lot of people leaning into that approach where they're trying to keep people in the building and just upgrade units when there's a demand to do it, as opposed to just kind of doing this blanket CapEx deployment across the board, just waiting until that demand for that new upgraded unit's actually there, which is a lot more conservative. I'm curious, have you guys had any, I'm not sure if you've had any deals that have lined up with the whole COVID thing for you to see this firsthand, but have you heard about any bridge lenders who have
Check 1, 2.
eased up on their terms just due to the fact that you can't evict people and there's things you can't do when the economy just shuts down for a couple months straight?
I would say yes and no. I say yes, bridge lenders have really come back in terms of getting more aggressive on their loans, but it's not for that reason. I think the reason is that as through COVID, I mean, aside from, maybe some like medical office or some industrial, multifamily is like the shining star of real estate right now, right? It's the guys in office and retail and mixed use and commercial. I mean, they're getting just hammered, right? Their collections are terrible. And frankly, we've had some of the best months we've ever had through 2020. And so I think they've come out of this saying multifamily is just has this really natural risk mitigation in terms of these downturns, right? You're never going to see it collapse. You're never going to see it double in value overnight. So I think that this data point, this 2020 is going to be another great spot where we can look back to and sort of see how well multifamily performed amongst other asset classes in real estate. I mean, if you had a bunch of money now and you wanted to invest in real estate, where else would you invest besides multifamily, right? And so I think the bridge lenders are starting to pull back and say, hey, this isn't quite as a risky proposition. And we've got tons of cash and low interest rates. Let's get more aggressive. Let's see if we can unload some capital into these multifamily properties with experienced operators and good properties and reasonable business cases. So we're not quite at pre-COVID levels, but we're getting close on some.
So that begs a question. Earlier you were talking about underwriting for zero rent growth over the 5 years, and I know a lot of people when COVID hit were starting to underwrite no rent growth for 24 months. But it's the numbers are showing that multifamily is really holding steady. So does that change your perspective on that, or are you still not forecasting any rent growth just to be on the conservative side, even though numbers are showing that there could be rent growth, even though COVID's here and income is a challenge and all the other stuff that's going along with this?
It's probably a mix of both. I mean, I think we do that to be conservative. I've never seen anyone else syndicate a deal and say, we're assuming 5 years of flat rent. I've just never seen that before. So we like to use that as a differentiator. The other thing is I can't control rent, right? You look across the P&L structure, I have an ability to impact and control nearly every line item to some extent. I can't control rent. And so that is a function of us. As multifamily operators, we don't set rent, we accept the market rent. So you can put whatever rent you want, and it doesn't matter if you're going to get it or not. So you're simply a function of a broader market that you can't control. So it's just the one thing we really don't have any promise on. And it's also the one thing, if you start to tick up rent and expenses, every deal is going to look amazing, right? You can take any deal and you ramp it up with a 5-year, you raise rents by 5% every year. Every deal looks amazing, right? You could convince yourself that something's going to be incredible. And so it's just one of those variables that we don't have a lot of information on, and it's hugely impactful to the return calculation. So that's why we tend to keep that thing back a little bit more, because it tends to be the point where I see syndicators make any deal work. They're willing to pay crazy prices that I wouldn't, because their top line number just grows, right? And that's so we just kind of want to stay away from that. And I hope we're wrong. I mean, hope we can tell our investors that we beat our year 5 rents within, a year of owning it. That'd be awesome. But I don't want my business case to sit on a long-term number that I just can't control.
Here's the way that Dan and I look at this, because we tweaked our underwriting in a very similar fashion to account for zero organic rent growth. Is that if you have a deal that works, it hits your return metrics without that growth in it, then worst case scenario you've already accounted for, right? So that's the ideal. You want to underwrite and present to your investors as close to worst case scenario that still hits the return metrics, because if things do play out that way, then you've done a good job of being conservative and set the expectations accurately. If you're wrong, best case scenario is that you're wrong and the rent actually does increase. You look like a superhero because you get to come back and say, hey, we said this because we were conservative, but look at these returns. It's much better to, you know, say, hey, we're going to hit 15% IRR and then show up in year 5 and say, we actually hit 22, versus showing up and saying, we're going to hit 22 and then only delivering 15, right? So very, very different things.
And Drew, I'm curious, when you said you didn't have any organic rent growth in your modeling now due to the COVID deal, is that zero net growth with
relative to inflation?
Yeah, because usually we'll have like 2 or 3% of inflation built in on the expense side. So on our end, we just net out, you know, there's no organic rent growth outside of inflation.
No, I mean, if you look at our top line, like gross potential rent numbers, it doesn't change from year 1 to year 5. It's identical for the full 5 years.
Do you have
Is your expenses growing?
Mm-hmm. Yeah.
Oh, so you have negative rent growth then, basically.
I guess that would be, yeah.
Yeah, technically relative to inflation then. Yeah.
Yeah.
Yeah, you definitely don't see that too often.
Yeah, no. Now you mentioned that you were looking at, you know, higher quality assets than you've been looking at in the past, you know, kind of leaning into safety, I guess. And we've been kind of doing the same thing. I'm curious if on the cap rate side, you mentioned that you weren't putting as much, I forgot exactly how you phrased it, but it sounded like you brought your capex, or not your capex, your cap rate assumptions on the exit down a bit from what you've been doing in the past. Do you still have some cap rate increase in there? Is it flat? I know you were kind of expecting it to go down because the Fed came out today and basically said, yeah, we're going to overachieve on our inflation goals. And basically rates are going to have to be 0 for like the next 4 years for that to actually work. So there's this big Fed ocean of support under the market. But what are you doing with cap rates right now in specific?
Yeah, I would say that we're trying to get a good measure of where the current market is and then add some cushion to it, right? So I think we're 50 or 75 basis points of where the market is currently trading at. That gives us a little bit of room. Cap rate valuation at exit's kind of an odd thing in some ways because the definition of cap rates, we could do a whole podcast on just what is a cap rate, right?
I love it.
But the definition of what a cap rate isn't universal. The definition of how you calculate it is not universal. I think it's a reasonable proxy for what a seller might be willing to dispose of an asset at the end of the term. But we never think in terms of acquisition cap rates. We don't think about operating cap rates. All we are measuring is how many dollars go into the investment and how many dollars go out. That's it, right? And some of my best deals, I'm buying things at a 2 cap, right? It's a nonsensical number for when at acquisitions. It's not really a measure of performance or value. It's a mathematical formula that not everyone agrees on. So I would say on the disposition side, we try to come out with, in some ways we back into a cap rate. We don't lead with a cap rate. And what I mean by that is we look at either valuations based upon rents per square foot, or we look at unit sale comp transactions, right? Because those are kind of the 2 things you build your business case around, right? Is you can tell anyone whatever the cap rate, it doesn't really matter, but are you able to get rents on a per square foot basis on a comparables or a sales transaction? And so that's kind of what we're measuring the exit at. And oftentimes, even at a refinance, like when you refinance a property, your valuation isn't your NOI divided by a cap rate. It's your NOI level compared to the debt rate it's allowed to support based upon interest rates and amortization. And in turn, that implies a cap rate, right? So the cap rate is the output of the valuation exercise. It's not the input to determine the value. So it's kind of the tail wagging the dog trying to drive with cap rates. I think cap rates is an output of valuation and financial acquisition and refinance calculations.
Yeah, I guess you could just look at it as an index for the market sentiment on, what the market expects to get, or what a market is expecting to be able to pay for a cash flowing asset. So I think you kind of made the point that it's kind of the tail wagging the dog. I think that's a good one. And usually we don't pay a lot of attention to them at all with the exception of just trying to forecast what things are going to be going for in the future, because we typically do value add stuff. And to your point, a cap rate on the acquisition side of a value add deal is completely pointless. Doesn't mean anything, but it kind of gives, I guess, for the investors of your deal, and some insight into what you're expecting the market to do over the next few years from a really high level. Like, is it going to get better, worse, or stay the same? So right now you're still kind of assuming that it's going to get slightly worse. It ticks up, or does it? Do you have it? I know you think it's going to come down, obviously, because Jerome Powell's over there just hammering down on cap rates more or less. But do you guys have some kind of going into COVID now? Do you have it still bumping up, or what are you doing?
Yeah, we still have it bumping up. Yeah, we still have it bumping up, but we're assuming our A cap, our an A class asset is going to trade at 4.75 today. We'll maybe put that at 5.75 or 6, right? So we've got a little bit of upward room, but even a 6 exit cap is a pretty aggressive number, right? By historical standards. So it's conservative. Like in 5 years, could we go up 125 basis points? I mean, that'd be a lot. We think that's on the high side, but from historical perspective, it's probably in line.
Mm-hmm. Yeah. But then to your point, we all kind of know behind the scenes, the likelihood of that actually happening is probably pretty low.
Mm-hmm. And I also don't want to build a business case around an exit value, right? I want to build a business case around the unit comp numbers, the rent per square foot transactions, my cash flow, right? The debt structure. I wanted to build a business case around execution of capital plan, property management, building everything around what is this going to be worth in 7 years based upon a cap rate, right? That's another way to solve a problem without actually doing all the work up front, right?
Yeah. And it's purely speculative, right? As we get further out, like nobody can predict what's going to happen tomorrow. Good luck trying next year. Like if you were sitting in our seats right now last year and you foresaw us in this current situation, then like you have some freaky powers, but you didn't. So like to have the expectation that you can see what's going to happen in a 5 or 7 year window on the length of these holds, it's just not going to happen. So if your underwriting is based on that, it's a pie in the sky. And we see this pretty frequently. We just looked at a deal that another operator put in front of us, and it is assuming the cap rate is going to get much more compressed in that 5 year window, which is probably true, we think. But to underwrite for it is a very different thing. I do want to get very technical here real quickly, because you mentioned you guys kind of back into your cap rate, and you do that by calculating the square footage and like the unit comparables in that area. For our listeners at home who are like, okay, how do I utilize that information and work my way backwards? How do I do that?
So there's a couple things. There's no way around this besides hard work, right? I think you can get your CoStar reports, you can get your broker information. There's no substitute for going out to your building that you want to acquire, draw an 8-block radius around it and just start calling every apartment building in that area, right? You need to know what the actual rents are, because things online don't work. Apartments.com rarely updates, right? So it's an exercise in saying, I need to know exactly what my units are trading at in this neighborhood. I need to know the exact square footage so I can back into what's my rent per square foot. Now it's not linear, right? I mean, as properties get bigger, your rent per square foot naturally gets lower, right? So your 3 bedrooms are always going to be lower in rent per square foot than your 1 bedrooms. But you kind of need to understand what that progression looks like. So that's one data piece, right? You just have to go out and build a spreadsheet and track all these things, how many units, how many types, and get those actual numbers. Comp shop them. On the sales side, that's probably where your broker is going to be really helpful, right? Draw me a circle within 1 or 2 to 3 miles of this, and show me similar properties of similar age, similar type, similar size, and sort of figure out, hey, where's the business case? What have these things actually traded at in different conditions, right? So if you can buy something here, but up here it can trade, you can buy it for 50 and a good property, trades at 100. Can you buy it for 50 and put in 25? And you've got a $25,000 cushion in there per unit. That's your profit, right? There's your business case, right? I can buy this for X, I can put in Y, and I know there's a delta between those 2 and Z, right? Where it's going to be sold at. And that's predicated based upon how you can calculate these rent comps. Excuse me. So that's kind of one of the pieces that you really need to get in. I think CoStar is fine. It's a great place to start. don't take investors' money unless you've made the phone calls yourself. That's not it's a starting point. It's not a final business case.
Mm-hmm. Yeah, I think you summed that up really nicely. It's you hit on a good point there. It takes a decent amount of just actually putting in the time of gathering the data, but fundamentally it's a very simple business model.
Yeah.
Right? It's very simple. It just requires some effort, which I think people kind of struggle with.
Yes. Yes.
So
I mean, the whole business is phenomenally simple, right? You have a hard asset, and every month it brings in a certain amount of money. And if you could have less money going out than money coming in, you've built a great business, right? And so it's just accurate. How can I accurately forecast and maximize the rent? How can I accurately forecast and minimize the expenses? It's a phenomenally simple business, right? It's hard to execute from the standpoint that it's hard to get both investors to bring capital to the table, to have brokers send you the good deals, to have the underwriting ability to figure out what is the good deal for your investors. And then to also be able to kind of bring together all those third-party partners like property managers and accountants and attorneys, right? To bring everything together at one time. So it's a highly coordinated effort, but at its core, it's pretty simple. And I think that's one of the things that makes this challenging is so many things have to happen so quickly and in the right order. Because this is like, let's get money, buy an apartment building. Well, all those pieces have to align in a very quick manner. And it takes usually someone quite a long time to develop all those components, those skill sets and relationships and capital raising requirements. And so, like what you guys are doing, building a partnership is exactly the way I see people being successful in this industry. It's being able to have people that can keep you accountable, either have complementary skill sets where, someone's good at this and someone's good at that, or they have alignment on specific focus, either asset type or geographics. And so having some of these complementary and alignment of interests and skills is really where I see people that can get their first $2-3 million deal, and then they're off to the races, right? And so having that partnership and develop those kinds of relationships that get these deals done is where I see people being successful. And I'll tell you, if you can get a $2 million or $3 million syndication deal done, you can do a $10 or $15 million one. It's not that much more work. It's a little bit more work, but it's not nearly as much work as you think.
I agree. I was wondering, there's one other quick question I want to get in here before we end, because I think it's...
Before I end this.
Yes, I know you're about to end it, Anthony. That's what you do. But I was curious, since you just... stop me if I start to say too much here, but since you just got done with the raise on something, I'm curious what you've been seeing from your investors in this kind of post-COVID world. Like, do they have new concerns, new questions? Are they looking for new things? Like
new expectations?
Yeah. What's different from, 6-8 months ago in your investor base, if anything?
I'm going to go on a limb here and say nothing. Right.
Good.
I think that when you have an investor base that no one is investing in that building, right? When I send out my marketing packet, when I send out my financials, there's no one that's going to do the kind of due diligence that I do. They're investing in me. They're investing in the trust and the experience that I have generated, which is why I've been able to raise a lot of capital with a very small amount of people. I don't have a big podcast, and I don't have a newsletter, right? I have a LinkedIn profile, and that's all I sort of exist on in the web. And so I would say that might be true depending on how you've sort of built your investor network. I don't think I got much things different this time than I did last time, because I think they trust who you are, and they trust that you have done well and you've communicated. And not all my properties are going perfectly, right? But we're upfront, and even the people who are in properties that things aren't going as swimmingly as we'd hoped, they're still putting money into the next deal because they know that we're communicating well, and that we built a level of trust and relationship that they can continue to put those dollars in. So I wish I had a better answer than that, but it's kind of nothing. I don't think, because I think back about the last couple of weeks.
That's the answer. I mean, if not much has changed, that's good. I mean, that basically goes to say that people who've been in these assets have seen how they've performed in the worst of times, and there's still an appetite, if probably not more of an appetite, I'd say.
Yeah.
Very cool.
So, Drew, if people want to get into contact with you, how would they go about that? You said LinkedIn.
Yeah, I mean, my email is just drew.whitson@gmail.com. And I'm happy to connect with anyone if they have any questions, or LinkedIn's a great way to sort of stay in touch. I try to post occasional deals that after I've closed, or I just recently posted a great deal where I talked about getting my investors together just kind of for a celebration dinner. So
That's cool.
happy to have you follow along with what I'm doing online, and that's about it. Otherwise,
Can I take a course from you?
yeah, yeah, come to Bethel. We'll take you. Well,
That's an expensive course.
Exactly.
I love it.
Well, that's awesome. We really appreciate the time. You had all kinds of great stuff to say. I think I'm even going to go back and listen to this podcast again because
Yeah, I think